Hi, I'm Ty, and this is my gardening accountant video series. In today's video, I'm going to be talking about avoiding the LLC disguised service payment trap. If you're granting a service provider ownership in your LLC and then giving them a special allocation of income, you may actually be making what is called a disguised service payment. The concept of a disguised service payment was provided in statutory tax law. The law references a vague standard of whether the new owner has significant entrepreneurial risk. The IRS has issued proposed regulations on that terminology, and that should clarify how to apply this rule. Now, although proposed regulations are not considered legally binding, the IRS has indicated that these regulations reflect their view on what Congress intended for this law. In other words, it's a pretty good bet that if your position doesn't follow the guidance provided in these regulations, these proposed regulations, the IRS will probably disagree with you. Based on the proposed regulations, we can now say that the IRS feels the following are the important factors in assessing whether there's a disguised service payment. First, and of greatest importance, is still the concept of whether the arrangement has significant entrepreneurial risk. Second, is whether the service provider's ownership is just temporary. Third is whether the service provider receives a distribution of profits in the same time frame you otherwise would expect them to be paid for their services if they were just an independent service provider. Fourth is whether the service provider only became an owner to obtain tax benefits. Fifth is whether there's a special allocation of profits and distributions to the service provider that is large compared to their continuing ownership in the business. And sixth is whether the arrangement actually provides for special allocations based on based on the services provided, and whether those allocations have different levels of entrepreneurial risk. These principles can help us form a more comprehensive understanding around the concept of a disguised service payment, but it's really the examples in the proposed regulations that provide the real clarity as to when the IRS believes this law is applicable. Let's talk about one of the examples. And so when you think about, well, how might this issue of a disguised service payment come up? Well, one example is that the IRS describes as, suppose you have a business that's constructing a building and it expects to generate $100,000 of rent annually from that business. Now that's the gross rent without expenses, right? An architect who performs services for the business waives their normal fee, which would be about $40,000, and instead they contribute enough cash to become a 25% owner of the business. This entitles the architect to 25% of the income going forward. However, the business agrees to also make a special allocation of $20,000 of the gross rents for each of the next 2 years to the architect. Now think about how unusual that is, because really it's the net profit, the rent minus the expenses, that owners normally would split. But in this case, we're saying, well, before we even consider expenses, we'll just take $20,000 of the total rents and give that straight away to the architect for the first 2 years. Since their fee would normally be $40,000 and you're doing that $20,000 a year for the next 2 years, do you see the correlation or the connection here, right? In the example, the IRS concludes that this special allocation of gross income lacks any significant entrepreneurial risk. That's because the business agreed to allocate $40,000 of gross income no matter what the ultimate net income after expenses was. Therefore, this arrangement is considered to be a disguised payment for services. So what does that mean for the business or the architect? Well, if the special allocation to the architect was considered part of their distributive share of income, which flows through to be taxed to them individually, they would have had $20,000 of taxable income in year 1 and another $20,000 in taxable income in year 2. That's the scenario where it's not considered a service payment. However, if it's a disguised payment for services, then it's not exactly clear when the architect would have to include the $40,000 value of services and taxable income, because they perform the services presumably at the beginning in year 1 as the architect. The disguised payment categorization could open the door to the IRS taking the position that the entire value of those services, the entire $40,000, was taxable immediately. Well, that's your risk. That's the issue with disguised service payments. There are certainly other scenarios that you could consider. But I just wanted to throw that out there and make you aware that if you have some kind of allocation scheme like that designed to compensate a service provider when you're forming or starting up a business, you may have this problem of a disguised service payment. And so yeah, that's it. I'm gonna get back to this great day of gardening. If you enjoy these videos, please like and subscribe to the channel. Tell your friends and colleagues about it. And I will keep doing them into the future as long as they seem valuable. Okay, take care now. Bye.